Hey friends, in today's video I'm going to share things that you should be careful about as a beginner in Germany. The biggest thing that works in your favor is the time in the market instead of timing the market. So I see a lot of people asking, okay, right now the market is going down, why should I buy or invest in these ETFs or these companies? The main thing is that when you are investing, the best thing that you can do is invest consistently because time is on your side. And in a long enough period, even if the companies or the market is going down, it usually recovers. And as you can see here, the market goes down and goes up. It's never a linear progression, it's always fluctuating. So here's an example. If you had invested 10,000 euros in the S&P 500 ETF from the 31st of December 2007 up until the 31st of December 2022, you would have gotten an 8.81% annualized return, and those 10,000 euros would have increased to 35,461. However, if you had tried to time the market and just missed 10 of the best days in those years, you would have just 3.29% annualized return instead of 8.81%. So at that moment, you would have 246 euros instead of the 35,000 euros. And in case if you missed 20 of the best days in that time frame, you would have a negative 0.17% annualized rate of return. So instead of 10,000, you would have 9,748 euros. And if you had just missed 40 of the best days in that time frame, you would be at a loss of 5.32% per year. So this would mean that you would be at a loss of 5,600 euros just in that same amount of time. So that's why I'm saying it's better to consistently invest in the stock market instead of trying to time the market. So when the stock market is going down, we have a negative sentiment and we try to sell our stocks and ETFs because it doesn't make us feel good. And when the stock market is going up, we are buying into it. We are buying a lot of stocks and ETFs. We are investing a lot of money. So instead of doing that, when the stock market is going down, you should, instead of selling your stocks or ETFs, you should always look into investing more. Because if you are investing in quality companies, those companies are bound to go up because the market situation might be different, the market sentiment might be different. But if it is a quality company, if the fundamentals haven't changed, the company is bound to go up. So what should you be careful as a beginner who is just starting with investing? So as a beginner, I would always recommend that you look into ETFs first, and then after you have gotten some experience in ETFs, only then should you start looking into individual stocks. So when it comes to ETFs, start with a broad market index fund, for example, the S&P 500, the MSCI World, or the MSCI Emerging Market ETFs. There are different options available as I have just shown you. So look for an ETF that generally has lesser total expense ratio. Another thing would be the accumulating or distributing ETF. A simple explanation of distributing and accumulating ETFs would be that distributing ETFs provide dividends that are given by different companies that are listed within this ETF, while the accumulating ETF does not provide the dividends to you as an investor. What this accumulating ETF does is it takes the dividends from those companies and invests in the ETF itself. So you would have a little bit more in terms of invested amount when you have the accumulating ETF, while with the distributing ETF, you get some amount of money each quarter or depending on how the frequency of dividends is given out by that specific ETF. In this video, I share how I invest in individual stocks. So thanks for watching Black Wizard, and I'll see you in this video.